Good evening, everybody. Welcome to Zuminate. My name is Julianne Peterson, and I am your host every Tuesday night for Zuminate. We have been doing this for over 6.5 years. Can you believe it? Erica, 6.5 years we've been doing
Wow.
this. It is incredible. We've built a great following. I am a loan officer for Old Capital Lending. So I'm here to help you put together loans, find sponsors, find investors, you know, put the whole team together. Because as a lender, we're going to look for the people that are on your team. Always, always be looking for who is the next person that you can do business with, whether it's a sponsor, I need more net worth, or if you're looking for investors, you can find all of those people right here in the room. But it's not a one and done. It is a regular exercise or practice to come to Zoom at 8 because, again, this is a long term investment, making relationships with investors and doing deals. So if you're looking at a deal currently, we're going to need your T12 rent roll and underwriting. Okay. You're going to package that all up. Those all should be in Excel and then an offering memorandum. Send that all to me. I want to know the address. I want to know the year. I want to know how much you want to pay. What's your business plan? Okay. All of that. Then we'll send it off. We'll get our analyst on it and we'll find out based on what's happening in the marketplace. Every market is different. Every deal is different. Every sponsor is different. So when somebody calls me and says, "Oh, what should I quote this?" It's like there's more to it than just sending out a price. We have to know a little bit more about the deal. So in 48 hours, I can turn a deal for you to give you a quote, can give you some notes about what the lender's looking at. Maybe the appraiser is looking at it and saying, the payroll's not going to be, $300. It's going to be 1,300. So we'll give you feedback and then we'll do the underwriting. We'll give you the underwriting. So you know exactly line by line how much to underwrite your deal. Because at the end of the day, folks, it's the lender is your biggest partner, right? We're going to bring 70, 75, maybe even 80% of the money to this deal. So we want to make sure that you see that before you put in the LOI. All right. Well, let's get on with the show. This is why you're here. Now, a lot of you are looking for money. We had Karin Hall here who spoke about U-Direct, meaning solo 401k IRAs, right? You're going out, you're asking investors, "Hey, you guys want to look at my deal?" "Oh, no, I don't have any money." Wait. You do have money. Let's do the 401k IRAs. Erica Neal is here, and I want you to understand who our industry expert is tonight. It is a great pleasure to welcome Erica Neal. She is the co-founder of Infinity Investment Strategies. She helps investors and business owners take control of their money through creative cash flow and wealth building strategies. Erica specializes in teaching clients how to leverage the infinite banking concept to create liquidity, reduce taxes, and build generational wealth. With a strong background in finance, real estate, and entrepreneurship, Erica equips investors with tools to become their own banker. You might not be me, but you can become your own banker so that their money works for them, not in the other way around. We're delighted to have Erica Neal here back on Zoom at 8. She's been here a couple times, but I want to welcome her tonight. I brought her here because everybody's saying it is so hard to find money. So Erica's here to help you find and help your investors find the money and opportunities to buy into these using their own money. So Erica, welcome again to Zoom at 8. How are you?
I'm doing well, Julie. Thank you for the wonderful introduction. That was great.
Of course. Now listen, before you get started, because Erica talks fast. So what we want to do is we want to bring her up as a speaker. So go up to the right-hand side. There's speaker view. So we want to give her all of our attention. Erica, I've known her for probably 5 or 6 years, maybe David, 7 years. And, it is a difficult time to find capital. And I'm sure you're hearing that, Erica, all the conversations you're having at conferences. I just saw you at the Old Capital Conference. We appreciate you being there. Um, I thought it would be helpful to have you here tonight to start these conversations, to make these investors the person that can create value for their investors. Like, hey, I
Mhm.
don't know all about this infinity stuff. I know Erica, we talked to her, but I think you should be a great resource. Now you've added value. So that's why I wanted to have you come on, explain what this infinite banking is and how everybody can understand it, to maybe just give a high level to their investors, and then you take it from there.
Yeah, absolutely. I think you nailed it on the head. There's so many people, GPs, sponsors that are doing a great job trying to provide information and education to their investors. And we try to help bridge some of that educational gap, especially in the infinite banking space. So, infinite banking is a way to, it's been called bank on yourself, be your own bank. It's the concept of becoming your own bank instead of keeping your cash and your liquidity inside of a bank account or, IRAs, 401ks, instead of all these alternate savings accounts. You have the ability to create your own private bank account, and we're using these specially designed cash value life policies. Now, most people think about, oh, well, life policy is if I die, my family gets money. And yes, that's partially true. But if you really want to nerd out, there's a whole IRS tax code dedicated to these types of policies, tax code 7702, but it specifically references the characteristics and the treatment of these types of policies. So, what we do is we show people how to focus on the cash value more so than the death benefit. Now, everyone's different on that. Some want a little, some want a lot, but really we're focused on the cash. And we teach people how can you store cash inside of this policy. And we have what are called the 4 pillars. When you take infinite banking and you plug it into what you're already doing, you have the ability to take advantage of the 4 pillars. The first one is lower taxes, and I'll go into these in a little bit more detail in a minute. But you have lower taxes. We're going to increase control over your money. We're going to lower your risk exposure, and we're also going to help you increase your leverage as an investor, as a sponsor, whatever that may be. So again, there's a lot of tax benefits, there's control, there's a lot of features that go into this. And as we go into it, obviously that helps people understand why we want to use it. The asset protections probably become one of the biggest pieces over the last several years, keeping your dollars protected. But the primary reason that most people look at this to get started is that you have the ability to recreate the banking system, right? So, infinite banking, you're going to recreate the banking system to your benefit. Because what do banks do? You deposit money with the bank and they pay you very little. And then they go out and use your money and they leverage it to go out and make more. They're creating arbitrage. You get to create that exact same scenario within your own policy. So, I'm going to give you an example. If somebody has $100,000 inside of their policy and they want to take out 70 and they want to go invest it into a deal. Doesn't matter. You can invest in anything and everything you want. You're the banker. You make the rules. You're going to pay simple interest on that policy loan. But as that 70 is out there working for you, getting a rate of return, your policy is still earning compound interest and dividends on the full 100,000. So you're able to do what Robert Kiyosaki says and give $1 multiple jobs. So even when your money's out there working, you continue to grow and you have a compound interest curve that's never disrupted. So we teach people, how do you, one, understand the policy, make sure that it's set up correctly, get as much cash in as you can. And then once you have your policy custom to you, how can you deploy that? How can we get it into a real estate deal? How can we go buy a business? How can we be an LP, GP, whatever that might be? So we teach people all the benefits, all, how can you help this, have this help you enhance, again, through the 4 pillars? And then how can we get this implemented into your cash flow strategy? Because this is a yes and, not an either or. It's put your money into infinite banking so you can do real estate or business or, right? So it's all of them to combined. It's not an either or scenario. So I'll pause for a minute. I don't know if you have particular questions or want to see visuals, but I don't know if
I
you had
think a
anything.
visual would be great, unless somebody in the room, before we get into this, has a specific question or something. Why don't we push them into the chat, and then I will I'll read those off to you.
Awesome. And then while we're doing that, I'll bring up some visuals because I am a picture person. You guys will come to find. Um, this is our team, by the way.
Hold on, you're on Zoom. Oh, there you go. Okay, perfect.
So this is our team. Like she mentioned, David White is my business partner. If any of you guys have seen him out and about, he's the guy with the beard. Here, let me switch out of this. It's freezing up on me. So while I'm talking about this, I'm going to close out of PowerPoint. It likes to freeze up on me. But as I'm kind of getting into this visual and while I'm waiting on this to reload, the big thing is, like I mentioned, most people are, especially in the entrepreneurship world, we kind of feel pigeonholed with, I have money, it's sitting on the sideline, but I don't want to invest in a deal right now, but I don't want my money sitting in the bank. Or if you're a KP or a GP, a lot of times you're required to keep a certain amount of liquidity in the bank. And if it's sitting there, we can get frustrated because we don't want our money sitting in the bank. We want it out there working for us. So this is a great way to fill in that gap. Here we go. Let me get back in here. This is a great way to fill in that gap. So like I mentioned, this is our team. We have our two service people that are here, Brian and Eliza. They are awesome. But like I mentioned, I want to bring up something with this idea of becoming a bank. Like I said, what a bank is doing with your money, they're taking your deposits and loaning it out. The deposit by itself is a liability. So on a bank's balance sheet, if you're going to become the bank, we have to recognize what assets and liabilities are to a bank. According to a bank or a lender, a loan is an asset. And why is that? Well, I'm charging, let's say Julie takes a loan and I'm charging her 7%. And Candace deposited money with my bank. The bank is only going to pay her 0.2% on that money. So they've created arbitrage with this scenario. My question is, in this bank transaction, is their rate of return, is it 6.8? No, that's only the spread. That doesn't actually tell us the internal rate of return on the transaction. So the interest rate spread is not telling the full truth. If you look at this like an investment, I invested 20 cents to earn $7, paying 0.2%, which is what the banks are paying, and earning 7% on those loans. That means if you invest 20 cents and earn $7 on one transaction in a year, you got a 3,500% return. That is what the banks are doing with our money. So the idea of this is, why don't we do it for ourselves? Because if you zoom out and you see what's going on here, who has the most control, access, and profit throughout the entire process? The banks do. So instead of allowing the bank to be in the middle, what we're going to do is take this entire system. If it ain't broke, don't fix it. We need to recreate this system. But instead of the bank being in the middle, we want to put you in the middle so that you can be the one to capture all this arbitrage. Okay. Now, the question is, how do we go about doing that? And this is the savings dilemma that I mentioned so many people are faced with. And my background, I come from the traditional financial planning space. I did the traditional financial advisory for a while. And what I found is that the Wall Street world is very much a my daddy can beat up your daddy space, right? Everyone's always better than the other guy. Don't do this, don't do that. And really, I've really developed a different philosophy now. There's no such thing as a good tool or a bad tool. There are, however, different tools for different jobs. So if I give you a hammer and I ask you, is it a good tool or a bad tool? What do you think? It depends, right? Like, what are we trying to accomplish? If we're trying to cut a piece of wood in half, we can't get mad at the hammer and say that it sucks. What we should be doing is identifying, what are you trying to accomplish, and then use the right tool for that job. When it comes to your money, there's 3 different functions. You have short-term needs, you have intermediate term needs, and you have long-term needs. These are the three jobs that we need our money to perform. So the tools designed for those jobs are going to vary. Short term is pretty self-explanatory. That's going to be a bank account, right? We still need these guys. They're not going anywhere. But when we're putting money into a bank, we're usually doing so because it's safe. I like to put that in quotations. And it's liquid. It's money you can get to pretty quickly. The catch with a bank account is that there's really not any growth. So it's money that we need to use within the next year, right? On the other end of the spectrum, we have the long-term category, and this is our investments. So this is a very, very broad category. This can include real estate, stock portfolios, businesses, 401ks, whatever. Something that over the long term we are hoping will grow. But we have to acknowledge that all investments carry risk, right? There's always a risk factor. And we also know that when we invest in something, it's usually tied up for a given period of time. It's not liquid. So especially right now, and Julie and I were kind of talking about some of the deals we're in. When I invested as an LP a couple years ago, the target was like 3 to 5 years. And now those deals that we've had for like 3 years now, they're saying it's going to be another 5 to 7. So we're kind of pivoting on time. My point is, when money is locked up for a given period of time, we're not going to be able to turn around and access it very quickly. Here is the savings dilemma that most people are faced with, but specifically investors and entrepreneurs. If you want safety and liquidity, you have to sacrifice growth. And if you want growth, you have to sacrifice safety and liquidity. So you can either put your money into a bank account or lock it up for the next 7+ years. So we kind of have this teeter-totter effect. And I cannot tell you how many times I've talked to people that have said, well, what about money that I might need tomorrow, but otherwise it needs to benefit me for the long run? What about all this intermediate time that I need to fill in for maybe a time that I don't have an investment going on, or I want to keep money liquid, or I have to keep money liquid? So this intermediate term box, this is where we come in. And we say, okay, we're going to give you the ability to earn guaranteed growth, more than what the bank's going to give you. Your money needs to be safe, so when you go get it, it's there. It needs to be liquid, quick and easy to access. We're going to throw in some tax benefits. We're going to keep it private and protected, and you're going to have control over that money going in and out. So I like to refer to these as the vault. Think about a vault or a safe in your closet or garage. You can put money in when you want. You can take money out when you want. It's safe, it's secure, but here's the key. Who knows how much cash you have sitting in your safe at home? Just you, right? It's nobody else's business. So you can keep your money safe and secure while accessing it anytime you want. So the question is, how can we recreate this system that the banks have done, but make it to your benefit instead of theirs? Okay. Here's how this works. You take money out of your bank and you use it to fund your vault or your IBC policy. Okay. You're then going to use your IBC policy. You're going to loan that money out, just like the banks do. You're going to loan that money out into your investments. The investments are going to cash flow back into your IBC policy. The cash flow from your investments is repaying your policy every single year. Because you are earning more from your investments than what can fit into your vault, because there is a limit, because your investments are making more than what you can fit into your vault or your IBC policy, there's leftover money that trickles down into your bank account. But now guess what? Now you're too liquid in the bank again. So you need to put more money into your policy so you can do more investments, and you rinse and repeat this process over and over and over again. So Robert Kiyosaki talks about the velocity of money. I like to call this the flow and grow, where you're consistently allowing your money to move and grow and compound between all the different assets that you have. Now, yes, there is some subliminal messaging here, if you guys didn't catch on to that. So Julie, like you mentioned, when I use this term, like, what is a wealth strategist? The goal here is, hey, I'm not going to say, hey, here's an IBC policy, and then we slap our butt, you're out the door. No. This is a full stream cash flow strategy where we are managing how, where's the liquidity here? What investments do we have? We're creating these cash flow systems, a full strategic plan on making this flow through for you and for your business and for your money, so that it can be as efficient and effective as possible. This isn't just a one-time set it up and then never think about it again. This is a lifelong wealth building strategy. Okay. Now, I did mention there's a policy design. I'm not going to spend a whole lot of time on this. Um, we're very picky about the type of policy and companies we use because the guarantees are incredibly important. The policies we use have a death benefit. Again, some want a little, some want a lot. It doesn't matter. But the type that we use have a guaranteed premium that can never increase, regardless of your age or health or anything like that. Your cash value is also guaranteed to increase every single year, regardless of what the stock market does. This is the only type of policy that's guaranteed to increase like that. Now, there are two parts of this that are non-guaranteed. First one are dividends. So the company cannot promise you that dividends will be paid. What I can say is all of our companies have been around for over 100 years and have paid dividends every single year since their inception. The other thing that's not guaranteed and is completely optional, you have the ability to put additional cash dump ins. This is where you take cash and dump it straight into your policy and it accelerates the growth. Now, how much? That's going to depend on you. Everyone's a little bit different. We all have a different number of zeros, but this is just high level what's happening inside of the policy. You have access to all of this cash value that's in here to use however, whenever, and whyever you want. And so we're using that cash to go out and deploy into whatever deal. Now, like I mentioned, there are 4 pillars. I'm going to talk through these pretty quick because I want to make sure we have plenty of time. The 4 pillars that I mentioned: lower taxes, increased control, lower risk, and increased leverage. Now, Mark, I'm so glad that you're here as a cost seg guy, because I always talk about depreciation and cost seg. Now, again, I come from the traditional financial planning space, and I saw so many more people in retirement paying more in taxes than they ever did while they were working, because all they did was max out their 401k and defer, defer, defer. I don't know about you. I don't think tax brackets are going down in the future, and I definitely don't anticipate making less money in 10, 20, 30 years of what I'm making today. So when we're talking about taxes, we want to be tax efficient, not just defer and kick the can. So the number one question I get on this is, can I use depreciation? Yes, 100% bonus depreciation is back, y'all. And so I think Denise asked the question earlier with cost seg. I am not a real estate professional. I do not qualify, nor does my husband. So to Mark's point, any depreciation that I don't get to use today, at some point, these properties are going to sell, the business is going to sell, and I'm going to have deferred depreciation that I can use to offset the sale and the appreciation at that point. So if you're not using it now, you'll get to use it later. All of the money, like you just saw, you're putting money in and it's growing. You're using all of your money plus the growth tax-free. When you borrow against your policy and you're paying interest on that loan becomes an additional tax deduction. You're able to write that interest off. And let's say later on down the line, you want to say, hey, Erica, I don't want to put money into my policy. All the money that's in there, I want it to start paying me. We flip the switch and it will spit out a guaranteed tax-free income to you for the rest of your life. So like I mentioned, I do not personally anticipate tax brackets going down. This is 1913 when the federal income tax was introduced or actually put into law. This is our tax environment in 2025. Historically speaking, we are in one of the lowest tax environments we've seen historically as a country. I want to protect and hedge against tax rates going up in the future, and this is a great way to do that. It's a guaranteed tax-free income later. There's also no UBIT. I don't know if any of you guys have had to deal with that, but there's no UBIT taxation. And then, yes, there is still a death benefit attached. So when you graduate from this world, everything you leave behind is completely tax-free. No inheritance, no estate taxes, no probate, none of that. It's a straight line transfer from one generation to the next. A great book I recommend is What Would the Rockefellers Do? Right? So they talk about cash flow banking. It's the same thing. So it's a really great way to be to protect your cash and your wealth from being eaten alive from generation to generation. Now, we want to be responsible about the way we transfer it, but at least we can be tax efficient. Now, let's talk about the control piece because I have not looked at the questions in the chat, but I would bet one of them is, this sounds cool, but how easy is it for me to get my money? Well, you're the banker now, so you make the rules. The money is very quick and easy to access. You can take it out as a loan or as a withdrawal. So when I say you borrow against it, you can either take it out as a loan and repay it, or you can just do a straight withdrawal. It's up to you. Most people, we're going to be focusing on the loans. No questions asked. Why are you using the money? It doesn't matter. The only thing they're going to ask you is how much do you want and where do you want it sent? You can go to Vegas. I know Julie was talking about going to Vegas. You can go to Vegas and put it on Black 22 for all we care, right? Like, it's up to you. I don't recommend it, but whatever. There's also no surrender charges. So we don't play games with vesting periods or anything like that. Your cash is your cash. You have access to it from day one. And you also have the ability to decide how, when, and if you pay back your loans. So if you take a loan against your policy, and I'll tell y'all, I'm in several multifamily deals right now that are not cash flowing. If I don't want to repay my policy loan, I do not have to. I personally choose to pay interest only. That's my prerogative, but you do not have to. You can use that money and you do not have to pay it back until you're good and ready. Now, the other question we get is, all right, how much is this going to cost me, right?
Can I jump in here for just a minute?
Yeah.
The access to cash. So let's say, I know we talked a couple weeks ago with Car and Hall, where you're buying a house and you want to live in it. You cannot use your money to buy a house and live in it. You can't put your kids, you can't put your mom and dad in that house.
Yeah, with the self-directed IRA. Yeah.
Correct. Can you use this facility for that to buy a house?
Yeah. So the house that
in.
I'm in right now, when my husband and I bought this house in 2018, we used some of my cash value as part of the down payment on this house. Yes.
Okay.
I have a 16-year-old. She'll be 17 coming up. And so we're going to be starting to look at college. And I'm actually going to talk about this. I'm planning on using a large portion of my policy to help her pay for college.
So there are
really good question.
What do they call them? Restricted uses.
Nope. Okay. So that's a good question. You're the banker, so you get to make the rules.
Okay.
Yeah.
Thank you.
Good question. Another primary topic is the funding, right? Like, how much does this cost? And it's kind of like buying a house, right? Do you want small and simple? Do you want large and luxurious? Everybody's different. Like I said, we all have a different number of zeros. So you get to decide how much you're funding in. Like we saw before, that base premium is locked in. It will never, ever increase. You decide what your comfortable minimum level is. Then you have the option to put additional cash. We call them PUAs. That stands for paid up additions. You're overfunding, putting extra cash in, and it's completely optional. Either way, when you're paying the base, the regular base premium, or you're paying the PUA cash dump-ins, what we will show you is how they are both increasing your cash value every single year. So this is not something, I know a lot of people feel like, oh, well, life insurance is, I'm paying for it and I never get to see that money. Au contraire. These policies are designed so that when you pay your premium, you're able to get to that cash inside of the policy and turn around and use it again. So when it's designed correctly, these policies are increasing cash value every single year. And then projections, right? They're guaranteed to grow. I don't know how long or how much y'all been in the financial world. You don't see that very often. They're very reliable dividends. Like I said, they've paid them every year for over 100 years straight. And we're using A-rated companies. So I'm going to really harp on that here in a minute. But these projections are incredibly accurate. I looked at the last 50 years dividend projection. They have either met or exceeded their projected dividend every single year for the last 50 years that I looked at, except for 2. And the 2 years they missed it by 0.5%. So when we look at these numbers, they're not just throwing stuff at the wall to see what sticks. They are very, very accurate and very, very good at their projections. So that's the control piece.
So let me just make sure we all understand. Today I call you. I want to put my money into one of these policies. How long do I have to hold it? Or tomorrow I can pull it out and buy something or be the bank to someone else?
So the actual transaction time, if somebody wanted money and they said, "Hey, I've already got if you've already got your policy set up and it's already funded, it's going to probably take 3 to 5 days."
How
If you,
about I buy a policy from you?
mhm.
I give you the money. When can I get that money? Within 3 to
Next
5
day,
days?
as soon as the funds hit your account, you can turn back around
Ah,
and
okay.
leverage that. Yeah,
Okay. So it's
good
not
question.
a year or 4 years in order for it to get up to a value, and then you can call upon those funds.
Yeah, good question. So there's no surrender charges. Now, let's harp on that, Julia. I'm glad you brought that up. So when we are funding these policies, the question is like, okay, well, how does that work, right? If I'm funding money into a policy, there's no such thing as, there's no such thing as free lunch. So what's happening is just like with real estate, just like with business or anything else that we buy, like when we go buy a property, there's acquisition costs to acquiring the property, there's closing costs and all of that. These policies work very, very similarly because we are purchasing an asset. So we don't have 100% equity day one. So the best way that I try to tell people, when you have cash in your policy, if you have 100,000 in cash, you can go borrow that and you can have that money in just a couple of days and you don't have to wait for it or anything like that. But as far as the funding, just to kind of clear any confusion, I like to use 100,000 because it's easy to do proportions. If somebody in year one puts 100,000 in, you put 100,000 in, you're going to have access to about 80 of that's going to be available in cash immediately. Okay. Now, year two, if you come in and fund a new 100 in year two, you're going to have access to about probably 90, 95. Year three is about 90, 95. By year four, at this point, so think about cash on cash with a multifamily deal. It starts off here and then it starts to tick up. That's our compound interest curve. In year four, we're usually dollar for dollar, where every dollar you put in is available in your cash value. All of it, whether it's premium or cash, it doesn't matter. Here's the thing. At that point, you have overcome the acquisition cost of the policy, and now your compound interest curve starts to go in that upwards trajectory. So let's say year five, maybe you don't want to put in 100, maybe you only want to put in 20. In year five, if you put in 20, now the policy goes up by 25. And then you put in 20, it goes up by 30. And then you put in 20, it goes up by 40. So at that point, you start to get what we call the multiplier on your cash because you've allowed compound interest to do its job. So all of that to say, your cash that you have in there, immediately available. We don't have 100% equity, just like real estate or anything else, but we're putting it in there to take advantage of that compound interest and allowing it to accrue and remain undisturbed.
I
Because
do have
that
another
growth is
question.
happening even if you use it to invest or not.
Got it. Because you have the regular, you've got the balance that you have already put in there. So
And
you're working off the
I have a
balance.
very high level example actually, that talks about the interest and all of that, because that's always one of the big questions. Now, on the risk factor, I'm going to just mention, we always talk about the bunnies and the rainbows, but we want to protect ourselves and our cash as much as we can against what we call wealth eroding factors. There's a lot of issues out there. So this policy allows you to add additional levels of asset protection because one,
Mm.
it's protected against market crashes. It's guaranteed to grow, no market correlation. Here's the funny thing. When the market goes up, the IBC policy goes up. When the market goes down, the IBC policy goes down. But when does most buying opportunity tend to present itself? When the market's down, right? So if we have our cash tied to the stock market, that means we're going to have to lock in losses just to go capitalize on an opportunity. These policies are always going up. So we're always in that position of buying power. We're protected against market crashes. We're also shielded from creditors. If you have a financial hardship, God forbid you make an accounting mistake, you get a tax lien. Now, every state, this is going to vary state to state. I know somebody mentioned they were from New York. Um, New York is probably the one with the least amount of asset protection. But even in that state of New York, the lowest asset protection, I want to say, is about 50%. So they will shield 50% of your cash from being seized by creditors. We're also protected from bank runs. Fun fact, I don't know if y'all know this. I actually posted a video on social media the other day We are in a 0% reserve requirement as of March 15th of 2020. The Federal Reserve has lowered bank reserve requirements to 0%. So just to be aware of that. When I mentioned earlier that these companies have an A rating, in order to get that A rating, the companies we use are required to keep a minimum of 100% reserves on hand for any dollar they guarantee. So this is the most secure way to have assets where you know that money is actually there. They can pay 100% of their liabilities. And then predators. This is a sue happy world, right? Like, unfortunately. So if you have an angry investor, a clumsy tenant, right? They slip on some ice or something like that. Or God forbid you get into a car wreck. I mentioned this earlier. I have a 16-year-old daughter. If she rear ends somebody and their neck hurts a little bit too much, or I live in DFW and I'm driving all over the place, if I rear end somebody and their neck hurts a little bit too much, they can sue me, my house, my car, my dog. They can sue me for everything. But again, my cash inside of the policy is protected from lawsuits. Now, let's get into the leverage piece because I want to go through that example of if you borrow against your policy and all of that. It's a high level example. Now, if you are, number 4, wanting to increase your leverage as an investor for your financial reporting, you get to use 100% of your cash value in your policy towards liquidity and net worth on your PFS. So if you need to show that as, being a KP, GP, or an accredited investor, you get to use 100% of your cash value. On the other side of that, you can shield your assets as non-disclosed if you don't want to talk about them. Like I mentioned, when my daughter starts applying for school and she's filling out FAFSA and scholarship applications, they can use anything and everything against her. 529 plans, IRAs, bank accounts, all of that hurts her chances of getting approved for these programs. I do not have to disclose a single dollar inside of my IBC policy. So I can use it to help her pay for college, but it won't hurt her chances of getting approved for those programs. So think about the vault door. You can open the door and show your cards or close it and hide them if you want to.
I'm going to just jump in here for just a second. And everybody, just so you know, when I say I need net worth and liquidity, this is what Erica is saying. To get an agency loan, you need to qualify with your liquidity. You can use, we call those marketable securities. You can use this, the cash value, to help qualify for a loan. That's what Erica is talking about. Very useful.
And I put on here the 401k, then IRA, they're 0%. I have seen lenders give up to 50% value on those. And the reason I just say that is they are tied to the market. So those values can fluctuate. So a lot of lenders will do a 50% valuation versus IBC, you'll get 100% because it's guaranteed. Yeah, good point, Julian. Now on the arbitrage, when you take a loan, the loans are not reported, and we are using what are called non-recognized loans. This means you're going to earn continuous compound interest even when the money is out there. So here's an example of that. Remember the very first thing we talked about with how banks make money. If you have a regular bank account or an IRA or a 401k and you have $100,000 and you want to take out 70, you go invest in this deal, you're going to get your rate of return, right? As you're getting cash flow from that deal, you're probably going to resave that money back into your bank to save it up for the next deal, right? And all the while, you're earning interest on the 30,000 left over. If you have become your own banker, you have that same 100,000 sitting there, but when you take out that 70, you're going to go invest in the deal, but you've taken that 70 out as a loan. Okay? When you take that out against as a loan, now when you take the cash flow, you're going to resave it into your IBC bank instead of your regular bank. So you're getting the same cash flow and the same rate of return. The difference is you're still earning compound interest and dividends on the full 100,000. So like I said, you're giving $1, multiple jobs. The question I get is, okay, Erica, this sounds great, but how does that work if I'm paying interest and earning interest? We have to understand the difference between money and math. There's a big difference here. So I'm going to give you guys an extreme example. This is not a real example, but this is an extreme example to prove my point. If you could deposit $100,000 and earn 4% a year over 5 years, but you also simultaneously had to take out a $100,000 loan and pay 6% over 5 years, would you take this deal? Or would you be like, no, get out of my face. This is dumb. Yeah, I mean, this is like we talked about, this is a negative 2% spread. Why would anybody do this? Well, let's take a look at it. A $100,000 loan at 6% interest paid back over 5 years would result in $15,420 in interest paid. And this is where I have people throw their hands up and say, see, why would I do this? I just lost $15,000. This is ridiculous. Well, what's been going on for the last 5 years while you've had that loan outstanding? You paid down interest at 6%, but you are earning, oh, I forgot to mention, yeah, that 15,000, don't forget, that's a tax deduction. You're writing off that interest all along the way if you're using it for business. But you're earning compounded. So if your 100,000 sat there and only earned 4%, which spoiler alert, it is more than that. If it only earned 4%, you would accrue $21,665. So you paid 15, but you made and earned 21. So I'm going to point a couple things out. Number one, is infinite banking the best rate of return you've ever seen? No, absolutely not. Your rate of return is your investment. Your rate of return is your real estate. While this is going on, you're getting that rate of return out here. This is just an additional arbitrage, an additional enhancement to the returns that you're already getting. Because I can tell you right now, your bank account's not going to do this. Your brokerage account's not going to do this. Your 401k is not going to do this. This is a way to enhance the returns that you're already getting. The second thing I would point out is keep in mind that this is assuming that you're paying 6% and only earning 4%. Like I mentioned, the policies do average more than 4%. And I have like 4 or 5 loans out right now. None of them are 6%. They are all less than 6%. So I use this as an extreme example to prove a point, but realistically, we can go through some more accurate numbers another time. This is just the difference between paying down interest and earning interest. So I know we are already at the top of the hour, so I'm
No,
not going to go in.
let's keep going. We've got
Okay.
everybody interested here.
I do like this slide because if anybody else has this question, if this is so great, why isn't everybody using it? These are a couple of examples of how infinite banking has been used and we may not even realize it. So Rockefeller Center in New York City. Actually, who was that said he was from New York?
That's Barack.
Barack. So fun fact, this is one of the largest privately funded construction projects ever built. So during the Great Depression, Rockefeller wanted to build this thing and banks were shut down because it's in the middle of the Great Depression. So he fully funded the entire construction of Rockefeller Center, with his personal cash value life policy. It wasn't affected by the market and they had access to the cash. Same thing happened to Walt Disney. He had a movie company, but he wanted to start a theme park. Couldn't get a loan. The bank told him no. They weren't. I always think about the banker that told Walt Disney no to start a theme park, by the way, like, oops. But they weren't very popular back then. So the first money that ever went into his theme park came from his life insurance policy. Doris Christopher, she was a home ec teacher in the 80s, wanted to start a very solid cookware line, took $5,000 from her policy, started Pampered Chef, sold it to Berkshire Hathaway in 2016 for like 1.6 billion or whatever. Foster Farms is the largest chicken producer in the state of California. They've used their policy for business and to maintain generational wealth. We have seen politicians all the time. Donald Trump, Joe Biden, the McCains, the Kennedys, all of them are using their policy to fund their campaigns and their own personal investments. So 2 schools of thought on this. If we want our money to remain safe and tax favored, we should probably put it in the same place as the people who write the laws, number 1. And number 2, if Republicans and Democrats can agree on something, it's got to be good, right? Like just throwing that out there. Now, if y'all get a chance, a little bit of homework for you, I recommend that you look up BOLI-COLI. This stands for bank-owned life insurance and corporate-owned life insurance. The largest banks and the largest corporations in the world hold a majority of their assets inside of these policies. JCPenney, they're kind of like our poster child for leverage. During the Great Depression, obviously they're a retail store. They can't afford anything. They took a loan against their corporate-owned policy, and they used that to pay every single JCPenney employee throughout the entire Great Depression. And they knew, again, it wasn't affected by the market crash. They had access to cash, and they knew they wouldn't have to pay that loan back until they could weather the storm and come out on the other side when it made sense. And then the last one here, OJ, I don't know if you think he did it or not, doesn't matter. He got some really good advice. He was told before he got indicted, which is key, before he got indicted, to put as much as he could into a life insurance policy. And that's exactly what he did. So when all the lawsuits and everything started coming down the pipeline, he was able to shield as much of his assets from being seized and levied. So that's why he was like golfing on Mar-a-Lago when he got out. So a little bit about us. Again, we have a traditional financial planning background. David and I have over 30 years combined financial experience. We are authorized practitioners. You can find us on infinitebanking.org. This is where you can find authorized practitioners who are certified in the infinite banking concept. And then we do work specifically with real estate investors and business owners because that's who we are. We're in that space. We don't just talk the talk, we walk the walk, we're in it. And we are an independent agency, which just means we're not tied to any one company. We have multiple A-rated companies that we use. So a lot of people want to know, like, okay, what does this look like? We do have more details. Obviously, there's a cash flow model. There's a lot more detail that we go into. If you want to know about that, we can talk one-on-one. Other than that, on our website, we do have a resource page. And I have also started a YouTube channel to start promoting some more content and education. And I also do a once a month interview with one of my clients each month. So you can go hear how some of them are putting their infinite banking policy to use. So, all right, I will shut up. We are 7 minutes over.
Oh, you're good. Everything was really well explained. So, can you use your 401k or your IRA for this?
Good question. If we were to use a 401k or IRA, we would have to treat it kind of like a backdoor Roth, meaning we have to, because all of the money that goes in here has already been taxed. If you close out of your 401k and IRA, we have to settle up on the taxes first. That's
That
not a
makes
bad
sense.
thing because if you're a real estate professional, here's what I would recommend. If you again, we always make sure it works with that particular person's scenario. If you close out of your 401k and you have taxes and you put that money into your IBC policy and then use your IBC policy to go invest in a deal that has really good cost seg or really good depreciation, you can offset the taxes that you would be paying for closing out your 401k or your IRA.
Good to know. Good to know. All
Yeah.
right. So Candace says she loves her policies and being the bank. I keep most of my funds in them, yet I've learned when getting leverage beyond my own funds. Let's see, I keep being at the bank. I keep most of my funds in them. Yet I've learned when getting leverage beyond my own funds, I have found the banks don't look at my policies as an asset or liability. Do you recommend only using one tier banks or ask the banks before applying?
I would talk to them before applying. So I'm going through the SBA process right now. And the government's shut down, so we're not going to be approved for, until that happens. But we actually met with our closing officer about a week or so ago. And in that conversation, they're asking about, hey, we're going to have to show proof of funds. And I told her, I said, well, I've got almost all my cash sitting in my life insurance policy. And the life insurance company can produce what's called a statement of cash, like a statement that shows how much cash you have. And I told her, when do I need to submit that? And she goes, no problem. Just submit that statement about 2 weeks before closing and then show the deposit about 1 week before closing. So the lenders and banks, I would double check on who you're working with, maybe in advance. And then Candace, let me know and we can get a statement of cash to show lenders, hey, here's documentation of how much cash we have sitting in there, because they should be giving you 100% credit for that.
Candace, you good with that? Make sense?
Yes.
Or even Debbie, Denise?
Yeah. Thank you.
Yeah, I'm really glad you brought that up.
Okay. Scott asks, how do lenders look at the money from these kinds of funds in terms of LTV ratio? Is that right? LY? I don't know what
That's
A.
correct. I've had familiar.
Okay, LTV ratio. Is it considered debt?
Wonderful question. It's not reported at all. So the loans are not reported. When it goes into your bank, it's same as cash. And so it does not affect your LTV or your debt to equity or your credit. They're completely private. So they're not going to factor that against you. It's not
So,
considered to be debt.
but it does go towards your net worth. Like it's not, it's viewable, right? As towards your assets.
Yes. So you can show your cash value as an asset. And then when you take out a loan, it's not reported to the IRS or any credit bureaus or anything like that. So, kind of coming back to that SBA example, obviously, while I'm waiting to go through that, I can't take out a loan. I can't go buy a car. I can't do any of
Mm.
that. But I'm going to take a loan against my policy while I'm waiting. And that's not going to affect my credit. So, it won't have any impact on the loan process. Am I answering your question, Scott?
You are.
Okay.
All right. Moses asks, are you restricted on how much you can fund a year into the policy? And are you a mutual whole life company where my principal is always protected?
Good question. So that's two parts. The first one, there is kind of a limit. I don't like this phrase, but it's being called the rich man's Roth. There's no income limits and there's no contribution limits, but it has kind of like that Roth status where it can grow tax free and you can use the money tax free. So, as far as how much you can contribute, prior to 1988, there was no limit to the cash. It was unlimited. I mean, this was like a free for all. Well, of course, people are dumping hundreds of thousands, millions of dollars into this, and Uncle Sam caught wind of it, and he didn't like it. Obviously, he's losing a lot of money on the back end with the tax. So they instituted what's called a MEC. MEC stands for Modified Endowment Contract. Essentially, this is the government's way of saying, hey, you can use this policy and take advantage of the cash, but you need to make sure that there's still a life insurance component of it. So to my point earlier, like I mentioned, if you put in 100 and 20 of it isn't available year one, 80-20 is usually, so we can usually, whatever your minimum is, we can usually get around 3 to 5. So I like to say about 4. So 3 to 5 times, whatever your minimum is, you can get about 3 to 5 times that amount in cash. And that's going to be your quote unquote maximum. Now, the maximum they're going to approve you for, this is going to sound morbid. They will not insure anyone they will not insure you for more than what you're worth. So they're going to like, all right, what's your income? What's your net worth? And if you have a net worth of, $100,000, they're not going to insure you for 50 million, right? Like the insurance company's smarter than that. They've seen
So
through files.
I've listened to people talk about taking out $1 million policy and then they have access to a certain portion of that. Is that kind of what your program is? Or is it, hey, I'm bringing in 100,000 this year, I'm bringing in 50 next year, as you mentioned, 20. I mean, how do your policies work?
So that's a really good question. Some people, if they say, hey, how much would $1 million death benefit cost me? If we're talking about death benefit, that's more of a life insurance conversation. If we're talking about, hey, how much cash can I get in here? That's an IBC conversation. So, right, like the mind shift here is instead of coming into it and saying, hey, how much is this amount of death benefit going to cost me every single year or month? Really, the mind shift is if I want to get X amount of cash in, what do I need my minimum to be? And what is that going to look like on an annual basis? So that it's the same vehicle. We're just using it differently depending on whether we want death benefit. Again, some people do, some people don't. We can adjust. Most people are focused on how much cash can I get in this thing. And then, the mutual, yes. So we are using A-rated, mutually owned, whole life dividend paying policies.
Okay.
We're very, very picky on that because we have plenty of risk and we have plenty of exposure and all of that with our investments and real estate and everything else. This is not an investment. This is our foundation and it goes into everything else. And so we want this to be secure and reliable.
So if somebody takes out a policy, is there a yearly fee that is charged for that policy?
No. You're just paying your premium and it's all baked into, like I mentioned, if you put in 100, you have access to 80, then 90,
Sure.
95, it's all baked in. And then after that, there's no ongoing management fee or
Yes.
anything like that. Nothing.
Great. Okay, perfect. Does anybody have any questions before we let Erica go? Because this is an option for your investors. And I think it would be helpful to jump on a call with Erica so you can speak wisely to your investors.
Yes. And I'll put my email in the chat. I should have done that earlier.
Julie Moses, I got a question.
Sure,
I
absolutely.
know the reason I mentioned mutual because I do have policies and I earn a lot of dividend as much as they're saying it's not guaranteed. And that's why
Okay.
she explained the concept of paying 4% to the policy, the insurance, and you're paying 6 on the other side for the loan. People forget that the compounding effect and the dividends earns the policy way more money than the 6% that you're borrowing.
Yes.
Now, the question I have for Erica, is can you at any point decide to not pay premium anymore because the policy is making so much money and still allow this to work?
Oh, yeah. You can, I ran one today for a lady and she's 56, 54. She's 54. And we ran a policy for her and she wanted to know, how much can I get in? How, in what short period of time? So for her, what we found was if she funded it for 4 years, it could be, and most of them are usually around 4 to 5 years if they're max funded and you get as much cash as you can. Most of them are set up so that you don't have to fund it anymore and it's going to continue to grow. So you'll have the option at that point to either stop funding it and let it be self-sustaining, or you can continue to fund it and you keep getting that multiplier because obviously it's going to grow faster if you put money into it. But yeah, there is a point where you don't have to fund it anymore if you don't want to.
Amazing. I mean, it's really something everybody should get a lot more information on. So if you're looking to educate your investors or yourself, please jump on a call, email Erica at infinity investments strategy.com. And let me say that again, Erica at infinity investment strategies.com. Just
Got it.
yeah, thank you.
It's long, but it's all spelled correctly.
It is. It's a long one.
I have a question.
Yes, Alex.
So, Eric, a question for you. You mentioned that on $100,000 loan at 6% for 5 years, you're only paying $15,000.
Yes.
How is that possible?
So let me go back here. Okay. This one's only showing month 33 through month 60, but the premise of this is as you're paying down your loan, that interest that you're paying is steadily decreasing. So your interest charge is going down, down, down because your loan balance is going down, down, down with the ongoing payments into that policy or into that loan. So as you're paying down your loan, you have less and less loan balance, so you have less and less interest.
Well, okay. But so your 6% loan on 100,000 is 6,000 just in interest payments for 1 year is $6,000.
Yes. And then it goes down the next year and then the next year and then the next year.
Agreed. But it's quite, I mean, I haven't calculated, but it seems to me improbable that it's only 15,000.
Yep.
Because unless you significantly overpaying your principal, because you're not showing this is months 23, so I'm assuming this is the second year through.
Yep, and I can
48.
show I have a calculator. I can show you exactly what
This
I did.
is
Not share my screen, so let me get the calculator pulled up and I'll show you.
because your amortization is 5 years. Okay.
Yes.
I have a second question. So while you're looking for it, what is the actual premium for life insurance on a monthly basis, or monthly or yearly basis?
Monthly or yearly, so you get to decide what that looks like. So it's going to be up to you how much you're wanting to fund into the policy. So when somebody comes and says, "Hey, I want to put, um, I want to put X amount of money into a policy. I want to pay whatever you want your premium to be." We have some people that want to save $10,000 a year. We have other people that want to save
No, I'm
7 figures.
sorry. I have to clarify. Not the what your premium is and what you decide to put in. What are the actual expense? So, what are your actual expenses for the life
I see your question.
insurance? Not the actual premium, because premium obviously is up to the client.
Yes. The internal cost, I guess, is kind of what you're asking. There's going to be
Yeah.
a lot of variables that go into that, specifically age, male or female. They do health, right? Some people are in better health than others. So the actual cost of that, as far as the internal costs, are going to vary from person to person. The best
Okay.
way to look at it is kind of like I mentioned in that analogy I gave Julianne earlier. If you put in 100, you have access to 20, and then the next year you have 90, 95. That first 3, 4 years, when you are putting money in and you're getting that policy going, what the company's doing is they're taking that money and they're setting that to the side and they're saying, Alex, we want you to live and have a very long, healthy life. But they put that to the side because God forbid you walk outside and get hit by a bus. They're going to have to pay that death benefit. So they put that into their risk pool. Once they've established that they've covered all of the risk that they need to cover, then at that point, your quote unquote cost of the policy has been absorbed. So to answer your question, I'd have to look at the actual actuarial tables and look at a mortality table to give you like per thousand or per 100,000 in death benefit what your cost is. The simple answer is it's going to be based off of age, gender, health, things like that.
But relative to the term life insurance, the whole life insurance cost is increasing every year.
Oh, no. So that's a good question. So because we're using whole life is guaranteed to remain level. It will not increase over your age. Yeah, really good question.
No, the premium is guaranteed not to increase. The cost, i.e., the component that goes to your internal cost, increases as you age. Is that
With an
not
IUL, it will. The
okay?
cost of whole life, what they actually do is they use a flat actuarial table and they're going to balance out the costs because they know based off of your underwriting how long, quote unquote, you're going to live. So if
Well,
it's older, if it's more expensive when you're older, which it is, right? You get more risky when you get older.
yeah.
They are creating a balanced cost over the life, which is why
Level cost. You mean the level cost?
I'm talking about the cost of your insurance. They're baking that into the internal factor of the policy. Now, IULs, there's no good or bad tool. One of the things that I like to tell people to be careful about is IULs do not bake in that guarantee. So to your point, Alex, as you get older and maybe the company changes or performance doesn't go as well, or you get less healthy, the cost, to your point, the cost internally can go up and it can start to become cannibalistic within the policy and start to have increasing costs inside the policy. That is a concern within an IUL. Whole life policies have a guaranteed cost of insurance that remains flat for your entire life based off of the actuarial tables from day one.
IUL, you're referring to Index Universal
Correct.
Life.
And I've written IULs. I have in the right context, but when I do it, I'm very, very careful that we discuss that because that is a concern and I've seen them implode because they can become more expensive as you get older, especially after you've had them for 15 years.
Okay.
And
the
then
other,
this is that loan table, by the way. So 100,000, 6% loan rate, 60 payments monthly because it won't let me do annual. I don't know why it won't let me do that.
That's all right.
Yeah. So like you said, in the first 12 months, the interest would have been probably around, not probably, it would have been 6,000.
Well, yeah, close
and
to.
then, And then the next 12 months, right here, 13 through 24, it starts to go down. 25.
Okay, so it's amortization.
And
So because
so,
your
yeah.
payments are $2,000. Yeah, that's
Yeah.
okay.
So that
right.
is where it's coming up with the 15,000 in total interest down
And
here.
it drops. Yeah. Okay.
Mhm.
Can you front load the policy?
Yeah, we recommend it. I
To
don't.
what extent?
I would say within the first 4 years. The first 4 years, we're going to front load as much cash as we physically can. Year one, we don't always put as much into year one for somebody who wants to do infinite banking, just because we want to be cost efficient. And like I mentioned, year one is where most of the cost is. So we don't want to, if you're wanting to front load, we don't want to put it all into year one because that's where you have the most exposure to cost. If we extrapolate it out over about 4 years, that's kind of the sweet spot to get it in as early as possible and get that compound interest going while keeping your cost as low as possible because we don't want it all in year one.
Okay.
Yeah.
And do you um one more question. So you mentioned that you could borrow it at
Mhm.
whatever internal rate, 6%. But the challenge is you probably can't write it off. You can't write off that interest even if you invested in a deal,
Oh,
right?
you
So,
absolutely can write off the interest. Yeah, I just did it. You get a statement of interest at the end of the year and it says you paid X amount of interest and
okay,
you use that as a it's a straight line
cost of
deduction.
funds, cost of
Mhm.
funds for your investment.
Exactly.
Okay,
And
perfect.
you can use it like I have a client that just bought a car. He bought a company truck. And so
Okay,
he's going to write off the interest on that.
Wow.
company truck. Okay, so
I
your
I think
effective cost is less than 6% because it's
I have,
pre-tax.
yeah, so like all of my loans right now, I have a loan at 4.8, 5.2, and 5.5. So all of them are less than 6.
No, 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 but I'm talking about it's pre-tax rather than post-tax,
Yeah, that's a good way to look at it because you're able to write that interest off. I see what you're saying.
right?
Yeah.
Last question. Julie, can I?
yes. And then we have to
So,
cut it. We got to
yes,
let you
it's
go.
last question. So, when you design these policies, do you combine the whole life and term insurance in order to at least for initial 5 to 10 years to provide sufficient coverage without jacking up the cost?
Yeah, you're giving all my secrets away, Alex. Yes. So what we do, we're going to take a whole life policy and we're usually going to layer a term policy on there because what that allows us to do is get your death benefit as high as we can while keeping your cost as low as possible. That is our roundabout way of, for lack of a better word, manipulating the IRS MEC limit that I mentioned. So I mentioned the modified endowment contract.
Yeah,
That is a function of death benefit and premium, and that determines how much cash you can put in. By adding a term rider, that means that you have a lot more death benefit, even though your cost is really low. And that gives us the ability to put as much cash as we can in there. Yeah.
got it.
Yeah.
Thank you.
Oh my goodness.
That
So
was a
much.
really, really good question.
Well, when you come to Zoom at 8, we have smart people here.
Yeah.
So they're always thinking and trying to figure out how they can better themselves and bring that to their investors. So, Erica, what a treat to have you. You're the industry expert tonight. We so thank you for bringing your expertise to us. And
Thank you, Jillian.
we
Thank
look
you.
forward to having you on again. And again, if you guys need or want more information, reach out to Erica. She is a wealth and she's passionate, as you can tell.